Alrighty, so in this video, you'll learn what are the different Forex trading terminologies out there. This is especially for those of you who are brand new to Forex trading. You don't understand what's the meaning of long, short, pip, bid-ask spread, these are all alien language to you. Then don't worry, this video will clear all your doubt, frustration, and confusion. So here's what I'll cover, right? Long, short, what is it? What is leverage and margin? What is a pip? What is bid and ask? What is the spread? Okay, don't worry if you kind of if it seems foreign to you, right? Because I'm going to, explain them right now. So what is long and short? So simply put, right, long and short refers to your trade direction. So if a trader says something like, hey, Rayner, I'm long euro dollar. This means that trader is, would make a profit if the price goes up. Means the trader is bullish, right? He wants the market to go up so he can make a profit. And if someone says, hey, Rayner, I'm short the pound dollar. This means that he wants the market to go down because he will make a profit if the price trades lower. So this is the meaning of long and short, right? Long means you're bullish, short means you're bearish, and you'll make money if the market goes down for short, and you'll make money if the market goes up if you're long. Moving on, leverage and margin, right? What is leverage and margin? So leverage basically means, right, how much larger can you trade relative to your account size? I've seen, people mentioning leverage like how much more you can borrow, but I wouldn't really use the word borrow down here because when you are trading Forex, your broker is not really lending you any money. Okay, it's just a term, right, that refers to how much larger you can trade relative to your account size. I'll just give you an example. Let's say you fund your account $10,000 and your broker offers you a leverage of 1 to 50. What this means is that your broker would allow you to trade up to $50,000 worth of currencies, right? Because it gives you a 1 to 50 leverage. So this is what it means, right? Your broker isn't really going to, physically or electronically lend you another $40,000 in your account. No, it doesn't mean that, right? It just means that you can trade up to $50,000 worth of $500,000. Pardon my math, right? 50 times 10 is 500, right? Up to $500,000 worth of currencies, right? So this is what I mean by a 1 to 50 leverage. If it's a broker that offers 1 to 100, you can trade up to 1 million, right? Just take the leverage factor and multiply by the amount of cash in your trading account. So that's leverage. Now, what is margin? So essentially, margin and leverage, they are two sides of the same coin, right? You can apply this formula. You just take 100, divide by your leverage factor. So earlier we spoke about factor of 1 to 50. So your margin, right, this over here is 2%. So what this means is that your broker require you to put at least 2% margin, right, in your account to be able to trade the 1 to 50 size that you want. Meaning that, let's say, to put it simply, if you were to trade $500,000 worth of currencies, your broker require you to put 2% of this amount in your account, which is equivalent to 10,000. So this is why I said they're pretty much, two sides of the same coin, right? Leverage and margin. And one thing to bear in mind is that leverage, right, it's a double-edged sword, right? You can potentially make more money, right, with a higher leverage, but at the same time, you can potentially, lose more in a faster period of time, because all you need is just a small percentage move against you, right? And you will lose, a lot, right? Depending how much leverage you're using. Okay, so leverage and margin, they are a simple concept, right? But when you are actually trading, right, I want to say this is that, I don't really take into account, leverage and margin when I'm trading. Okay, because when I'm trading, I always have my stop loss in place, and from there on, I can calculate the appropriate position size for my trade. And even though I'm trading with high leverage, right, I won't lose a huge chunk of my capital because the risk has been taken into consideration. This is actually, advanced stuff. So if you really want to, learn more about leverage and margin and why I say it's irrelevant to your trading, right, you can go down and read this article that I've written, tradingwithrayner.com/forex-risk tradingwithrayner.com/forex-risk-management. It's a tongue twister, right? I'm not going to repeat this anyway. The link is here. So if you want to, see more about why I said that, right, that leverage is irrelevant, I talk about it extensively in this article over here. Forex risk management and position sizing. Okay, but the general idea of leverage and margin, I hope I've conveyed it to you clearly in this video. So moving on, right? What is a pip? A pip basically represents a point in percentage, right? It's the smallest price movement in the forex market. Now, I won't say it's the smallest price movement because there is something called the pipette. Okay, but it's not really a very useful thing to talk about. So let's just focus on pip. So pip basically refers to the point in percentage. So for most currency pairs, right, the pip is the fourth decimal place for most currency pairs. For the yen pairs, is the second decimal place. This is something that you have to know. So let's say we talk about euro dollar. Let's say euro dollar is trading at 1.0012, and let's say it moves up, right, to 1.0015. So how many pips did the market move for euro dollar? All right, you just take 1.5 minus 12 and you realize that it moved up by 3 pips, right? Just 3 pips. It moved up by 3 pips. For the yen pairs, right, let's say we talk about the dollar yen, right? Let's say it's trading at 120.01 and it moves to 120.05. How many pips did this market move? Okay, it moved up 4 pips. 4 pips, move up 4, right? Because for the yen, remember, I said that you have to look at the second decimal place. Okay, so this is slightly different, right? For most of the major currency pairs, if you see like, euro dollar, pound dollar, right? You're typically referring to the fourth decimal place. And for the yen pairs, you're looking at the second decimal place. So moving on, right? What is a bid and ask? So this can be a little tricky because depending on what markets you're trading, if you're trading the futures market, the bid and ask mean different thing compared to someone who is trading the forex market. So since we are dealing with forex, right, I'll just explain it in the FX market term, right? So the bid is basically the price that you can sell at. The ask is the price that you can buy at. So one thing to note is that when you're trading forex, there isn't exactly one price in the market. There's always two prices, the bid and the ask. So let's say again euro dollar. Let's say the ask is at 1.0015. Okay? And the bid is at 1.0014. So if you want to sell euro dollar right now, you will sell it at this price. If you want to buy euro dollar right now, you buy it at this price. So depending on your trade direction, okay, you are being offered different prices when you're trading. All right, so this is what I mean by the bid and the ask. And one thing to note is that, okay, I didn't write it over here, but the bid is always lower than the ask. So I think I'm just going to, just write this down. Bid is lower than ask, and vice versa, right? Your ask is higher than bid, right? This is a fact of trading, right? The bid is always lower than the ask, and the ask is always higher than the bid. So moving on, right? What is the spread, right? So you already understand what is the bid and ask. So the spread is simply the difference between the bid and ask. So again, another example, if that I'm sick of euro dollar, let me give me dollar Canadian, right? Dollar Canadian. Let's say it's trading at 1.1125. This is the ask. And the bid is 1.1122. This is the bid. So what is the spread? The difference between bid and ask. So you just take this one minus this one and you realize that the spread is 3 pips on dollar Canadian. Now you might be wondering, hey Rayner, why do I have to pay 1125 to buy, and when I sell I can only sell at 1122? Why do I have to lose these 3 pips? Well, simply put, right, your broker, the market maker, needs to make a living as well. So this is the form of transaction cost that is being passed on to you, right? They have to make a living. They can't just provide a free service. So they can't provide a free service. So this is the so-called transaction cost in the forex market. You're paying it in terms of the spread. So of course, right, different currency pairs, depending whether it's a major, exotic, and stuff like that, have different spread range. But generally, the major currency pairs have a tighter spread. Okay, now that you understand this, let's do a quick recap. So I know I've covered a lot in this video, right? So first and foremost, I discussed what is long and short. Simply put, it's your trade direction. Talk about leverage and margin, right? I say that this, simply put, right, it's a double-edged sword, right? The more leverage you trade with, right, the easier it is to blow up your account. But again, with proper risk management, right, leverage is pretty much irrelevant. As I've, I point you to that article to go and read more about it. That's a little bit more advanced. Then I talk about what is a pip, right? The point in percentage. For most currency pairs is the fourth decimal place. For the yen pairs is the second decimal place. Then we talk about a bid and ask. Bid is the price that you can sell at. The ask is the price that you can buy at. Then we spoke about the spread, right? It's just the difference between the bid and the ask. And this is what your broker makes, right? This form of transaction. Okay, so with that said, I have come to the end of this video and I'll see you in the next.